Hey, Dividend Growth investors. This is Derek here from the Dividend Talk podcast, a podcast that discusses dividend growth investing with a European flavour. Today I'm going to share with you my portfolio for January 2023. We'll have a look at some of the companies that I bought along with the dividends that I received. All that and more. See you on the inside. So the first company that I invested in this month was the NN Group, ticker symbol NN.AS if you're on Yahoo Finance. The company is headquartered in Amsterdam, the Netherlands, and provides a range of different insurance and pension products and services, including life insurance, general insurance, and pensions. As you can see, they're active in 11 countries, mainly in and around Netherlands, Belgium. They also have some operations in Spain, Eastern European countries, and Japan. So the company itself is known for their innovative and customer-centric approach to financial services. It's actually quite strong. When I talk to people from the Netherlands, they always speak highly of this company. They were spun off in 2014 from the ING Group, and as I said, they are now listed as their own company. Looking at the company on Kyfin, which is the app I use to do kind of a screen or a basic analysis of a company before looking at their annual reports, it looks actually like a quite decent company. At the moment, you've got a starting yield of 6.38% and a forward PE ratio of around 7.3. The dividend growth as well is quite impressive. I know the company has only been around really since 2014 when they were spun off from ING, but they've got a 5% annualized growth rate a 5-year annualized growth rate of 10.56%, and last year they increased their dividend by 6.67%. So you can see those numbers are quite impressive. The one thing that I will note is that if you look at the dividend yield and payments, you might notice that in 2020 it looks like the dividend yield was suspended, which it was, but that was through no fault of the company. The Dutch government at the time did not allow any of the Dutch companies to pay dividends during the pandemic. So this happened, but as soon as they were able to pay dividends again, as you can see, they were straight back on and continued their growth. So in the future, I don't expect the annualized growth to be around 10%, but with a 6% dividend yield starting out, if I can make maybe 2-3% long term, I will have a decent return from these guys, so I'll be happy enough. So the second company that I invested in this month was SONOCO Products Company, ticker symbol SON. So founded in 1899, SONOCO is a global provider of diversified consumer packaging, industrial products, and packaging supply chain services. Impressively, they are in operation in over 100 different countries worldwide and employ around 20,000 employees. I actually first came across this company when I was researching an Irish packaging company called Smurfit Kappa. So Smurfit Kappa is a nice little Irish-owned company that has paid consistent dividends, and while I was researching them, I was looking at some of their competitors, and SONOCO popped up, and when I looked at SONOCO, it looked like a better option to me. So if you look on the screen, you'll see the screener that I use for a company on Kyfin. So I look at a few key features, but what I do like to see is, first of all, I do like to see revenue growing. I like to see that their margins are stable. I don't particularly mind if they're growing, but I certainly don't like to see them drop sharply. So you can see the first two items tick the box quite nicely. Their revenue is growing reasonably well, and the gross margins are going up as well. Net income is stable and growing. The only concern that I have is their free cash flow. So you can see it is quite choppy, but it's not a huge concern over the last 10 years as it more than covers the dividend. They've had a decent payout ratio, but certainly in 2001 and the last 12 months, we can see free cash flow is not really covering the dividend. So that's the only bit of concern that I would have, and it's something to keep an eye on. We know that it's been a tough year, particularly with rising costs and so on. So it's something to be aware of, and if this trend was to continue happening, particularly this year and next year, I would have to reevaluate my position. But as I said, this company has been around for a long time, and if you look at their dividend history, they've actually they say that they've been paying dividends for over 100 years. So the company has said that. I can't verify that, but what I can verify is that they have increased their dividend for the last 40 years. So it is a dividend aristocrat. So they have a really, really good history at maintaining and increasing their dividend. If you look at that chart, you can kind of get a picture of what I mean. At the moment, they have a nice 3.16% dividend yield, and what I do like is that their annualized growth rate is in around 4 to 5%, and that's kind of consistent over the last year, 5 years, and 10 years. So with a 3% dividend yield, I would be looking more around for a 5%, but if I get 4, I'm reasonably happy with these guys. So as I said, free cash flow is the only concern. I'm not too concerned at the moment, and I might do a deep dive on these for you guys just to go through why. But as I said, it's a small starter position again in my portfolio, and a company that I am happy to own. The third company that I added to my portfolio was VICI Properties, ticker symbol VICI. Now, VICI Properties is a real estate investment trust, otherwise known as a REIT. It's pretty much focused on the gaming and hospitality and entertainment industries. So it was formed in 2017 as a spin-off from Caesars Entertainment, and it pretty much owns most of Las Vegas, and that's pretty much what enticed me to these guys. I don't have too much REIT or real estate investment trust exposure into my portfolio, so I really wanted to start adding a little bit more. I do have realty income, so this one just stood out to me a little bit. And then if I look at Seek and Alpha, it got some really, really good reviews. You can see that it's a strong buy by pretty much all the Seek and Alpha's authors, Wall Street, and their own quaint rating system. They don't have a long history in paying dividends, but they have paid a consistent dividend since they were spun off in 2017. And as we can see, the annualized growth rates are quite aggressive. So it's currently growing at around 8% per year on top of a 4.52% dividend yield. So you can see why a lot of people in Seek and Alpha quite like this company. I'm not sure if they could keep that up for a long time, but certainly in the next 2, 3 to 4 years, I expect the same kind of growth rate from this company. So the last 2 companies that I invested in are actually BDCs, so business development companies. The first one is called Ares Capital, ticker symbol ARCC, and the second one is called Capital Southwest Corporation, ticker symbol CSWC. So pretty much these 2 are income plays for me. So they've got really high yields, not much dividend growth, but I mean, with a high yield of around 10%, I don't need a whole lot of dividend growth to give me a decent return. So before investing in these, I used to invest in CEFs, which are closed-end funds. And I used to invest in them, a small portion of my portfolio, which gives me a high yield, just to have a little bit of diversity. But unfortunately, Interactive Brokers closed that loophole where foreign investors, i.e. Europeans, could invest in them. So closed-end funds, they do not issue a key investor document known as a KID, and under EU law, we're not allowed to invest in companies or funds that do not produce this document. So that was a shame. I was learning about them at a relatively slow pace. I was taking it slow. As I said, it's a small percentage of my portfolio, but since I no longer am able to invest in those type of companies, I sold all my positions in them, and I now invested still a small part of my portfolio into these 2 high yielding companies. So I've lots to learn on BDCs, and as I said, it's a small part of my portfolio. It's a pure income play, and it's something that I'm going to learn myself over the next year or 2. So stay tuned, and the more I learn, the more I will share with the community. For the rest of my purchases, I added to already existing positions such as Blackstone, which I'm slowly building a position in, Siemens, which is a company that I really don't own enough of. I think the valuation is a little bit high now, and as soon as it drops below maybe 130, 120, I will add a little bit more. But this is one of those companies like Texas Instruments and Johnson & Johnson where I add 1 or 2 shares every month or every couple of months just to try and build a decent size position in them. I also bought a little bit of British American tobacco. I just kind of realised that tobacco stocks actually make up 9% of my portfolio, which is quite large. BTI is roughly around 2.1% of that, and Altria, which ticker symbol MO, is worth about 6.6%. The reason why Altria is a little bit high, I was using that in an option kind of strategy where I was selling cash secure puts and cover calls. I've now decided for 2023 that I'm no longer doing that. I think it was a little bit of a distraction for me. I was spending a lot more time on that and not enough time on my dividend growth portfolio. And I think sometimes, particularly with me, greed and chasing high yields and chasing maybe that high premium all the time was something I got caught up in. And although the premium on Altria was quite low, there was definitely other companies out there that I was chasing that on. So I just want to refocus myself in 2023. So I'm thinking about trimming that position. I don't need multiples of 100 shares of Altria in my portfolio. And actually, if you listen to our last podcast, I'm not quite sure on where Altria's growth is. British American Tobacco certainly seem like a more well-managed company, and they've without doubt have a lot more success with non-combustibles. So that's something that I'm going to think about over the next month or two. But I suppose with Altria at the minute, I'm getting quite a high yield, which is making me hold on to them. But I'm thinking in the next month or two to start trimming that position and maybe moving some into British American Tobacco or moving it elsewhere altogether. A couple of other companies that I bought was Viatris, ticker symbol VTRS. It's pretty much a full position for me now. It's roughly worth 4% of my portfolio. You have a decent dividend yield. I think they're incredibly undervalued. But again, it's quite a risky play. I just think that it's so undervalued at the moment that the upside outweighs the risks at the moment. And then the last one that I added to was T. Rowe Price. Again, that's now 3% of my portfolio. T. Rowe is an asset management company. It's a wonderful company with a very, very strong balance sheet, and I really recommend that you check out my buddy's European DJI, his blog, where he wrote a post. It was his first purchase of the month, I believe, and it was actually my last. But it's a fantastic company, and I will link to his article below. So as dividend growth investors, we love to see our dividends grow month over month and year over year. So if you compare what I made in 2022, in January it was €86.24. In 2023 that increased to €130.78. So that's an increase of 51.65%, which is quite reasonable. I take that every single year. The biggest payer was, of course, Altria, which gave me €87.53. That's minus the withholding tax and then converting it into euro as well. I do have a couple of CEFs which I've mentioned that I've sold or in the process of selling. So the first one I have is ticker symbol CHY, which is Calamus Convertible and High Income Funds. That gave me 157. Now this is a monthly paying one, and that was paying consistent dividends every single month for me at the time. Ticker symbol EOS is also a monthly one, so that's an Eaton Vance Equity Income Fund. And then we have GLO and PFD. I think I still actually own them. I have sell orders in for them at the moment, but I haven't yet sold them. The last three dividend payers actually were three new positions last year, and they were HPQ, which is HP Inc., WP Carey, and also Comcast, ticker symbol CMCSA. And in total, they gave me a whopping €25.33 in dividends. So overall, it's a quite pleasing month. What I do notice, if you look at my graph, I've made quite some changes over the last 5 years. I started dividend investing in December 2017. So I would have received my first dividends in around 2018, but my portfolio has has changed quite a bit over that time. Part of that reason is when I first started, I was following the Dividend growth investor. I think lots of people follow him on Twitter, his blog, and he has this service where you pay him $5 a month, and he gives you what he's buying to achieve 1,000 a month every single month in dividends after, I think it's 10 or 12 years. So when I first started investing, I didn't know where to start. I thought it was a good place to learn. But what I found was I wasn't really learning. I was just briefly reading what he was doing and then buying it. But I really wanted to start learning on my own, so I cut a lot of the portfolio out from that time, and I'm starting to build a portfolio that I'm comfortable with. So I don't anticipate the selling to be quite as aggressive or quite as high as it was over the previous 5 years. I know I've had to sell some closed-end funds, but that was kind of forced due to interactive brokers and European laws. But I'm hopeful that I won't really have to start selling this year anyway. So that's my plan. If you look at the dividend chart that I have, these are the dividends that are received over the last 24 months. As you can see, April and May are pretty much my big months. That's because a lot of our European companies will pay in those months, so I'm looking quite forward to that. February is also quite stronger than January historically, so I'm expecting to see an increase there as well. I think I've received 3 dividends already this month in February, and I'm already getting close to January, so I'm looking forward to seeing how I perform next month. So the last thing we'll look at is my projected annual dividend income for 2023. Currently stands at 11.26%. I've actually increased the target of this year. It was in and around 23,000, but I've actually brought that up to around 32,000. A mixture of inflation, lifestyle creep, and lots of other stuff means that 32,000 is a more realistic target for me to hit if I want to consider either retiring early or even reducing the hours that I want to work. So 32,000 just from dividend income is what I'm aiming for. If you looked at my sector allocation, consumer staples is 21.58. It is creeping down. Thankfully, it was up around 40% at one time. Healthcare, financials, and energy and industrials make up the top 5. As you can see, REIT is quite low. Technology is quite low as well, and CEF, that's including the 2 new additions that I had from the BDC. So I'm putting them as CEFs as well, just to make that distinction. In total, I own 44 companies. My portfolio yield is roughly 4.93%, and my largest holding is BASF from Germany. They make up 8.24% of my portfolio. And my largest gross dividend, so this is the company that has paid me the most dividends since I've began dividend investing, which is ticker symbol MO, which is Altria. So there it is. There's my portfolio review for 2023 in January. Quite a nice month to start off the year with. As I said, 51% dividend increase is quite nice. I've been quite active in buying companies and moving some of my income out of options or what I had sitting on the side and putting it to good use. So stay tuned, and I will try and do something similar next month.